Welcome back. You're tuned in to Chartbusters here on CNBC TV 18. Well, the markets are looking quite good, but earnings season, so results are coming in thick and fast. And we got a number over the weekend, that's Ramkrishna Forgings. They saw margin expansion in the third quarter, along with the profit growth of close to around 35%. The volumes too registered a good growth, along with expansion in realizations. Now, to tell us about the past quarter, what's the way ahead as well, we're joined by Mr. Lalit Khetan, the Executive Director and Chief Financial Officer of the company. Hi, Lalit. Thanks so much for joining in. Well, give us a couple of details first on the tonnage front. I'm looking at the 9 months. I think you've done close to 96,000 tons. What do you end this year with? That's FY23. Last year, you clocked around 111,000. And given that you have a capacity expansion, which increases your capacity by close to 25%, what's the outlook on volumes for FY24 and FY25? Go ahead.
Yeah, so FY23 looks quite good in terms of volume, and we expect further expansion in volume, what we did in Q3 in Q4, and at least 15 to 20% more in FY24.
FY24, 15 to 20% growth.
Yeah, minimum 15 to 24% growth we are looking in FY24.
And 25, you'll have the entire capacity that will be available, right? For FY24, you'll be having this extra 56,000 tons or only for half the year. But for FY25, yes. What kind of a number are you looking at?
So see, we are looking to grow at a CAGR of around 20%. Okay. So that should be the number.
All right. You do have a potential revenue target of almost 5,000 crores by the entire capacity that comes in as well. But, you know, let's talk about the acquisition bit, Mr. Khetan, because you've also announced the acquisition of JMT Auto. What kind of revenue potential do you see from this acquisition? I mean, you've... the overall cost is 125 crores with 70 crores being paid upfront. What is your sense of the return that you can generate on this? I mean, one, the synergy benefits on revenue and costs and additional revenue that comes in?
Yeah, see, this will be acquired in SPV, and the additional revenue at the peak turnover can be anything between 500 to 554. And I hope we will be able to get it on stream once we get the order from NCLT in 18 months' time.
And by when do you reach the peak revenues of 550 to 5?
It will take 2 to 3 years.
Okay, and what kind of margins do you see in this business?
Margins are quite good because they make a lot of value-add product in JMT Auto apart from forging. So I think margin will be much better. We will be looking at anything between 24 to 25% EBITDA margin.
Oh, very good. All right. So, and this is likely to be, so you're saying in the next few months, you'll take over this asset. In 18 months, you'll have full control. And post that, you'll ramp it up with margins of around 24 to 25%. We're getting that correct, right?
Little correction here. See, it depends upon the NCLT order.
When is that expected?
That's not in our hand, so the court has to decide. But we hope next 3 to 4 months max it has to come. Okay. And after that, we need to refurbish the unit and do some repair and maintenance to plant machinery, and that will take us around 18 months.
So this entire acquisition gets closed out by the end of FY24.
Correct.
Got it. All right. Give us a couple of more numbers then. The debt reduction, for this year has taken place, I think close to 300 crores odd. You're hovering around 1,300 crores. Now, by the end of...
we are right now at, gross debt is around 1,300 crores. Yeah, correct. Okay. So we are looking to reduce 300 to 400 crores every year. With the kind of growth we are expecting and kind of margins with the with the acquisitions, we are expecting to at least 300 to 400 crore reduction in every year.
All right. As far as your non-auto business is concerned, railways and off-highway products, you had said that this could increase in contribution to your overall revenues. So how much has railways done so far? What's the projection there? And the non-highway business?
See, overall non-auto business is around 20% right now. And but railway is going to contribute quite significantly in FY24 and further improve FY25. And we have a target to achieve the non-auto to 30% by FY25.
And non-auto has higher margins, is that so?
Yeah, little higher margin, 100, 200 basis point more.
Okay. And defense, have you looked at that? Are you all getting orders from defense? Because that's another sector that we hear a lot of positive commentary and a lot of focus globally as well as here in India. So is defense
No,
another
but
vertical that a potential opportunity could come? Or for the time being, I'm just looking at your mix, 80% is coming from autos, rail is only around 3%, and you have mining, earth moving, etc. That's around 8% odd. So does defense find a mention
yeah.
in here?
No, we are not into defense right now, and right now we are not looking at it also.
Not located. Okay, great. The other big point, Lalit, is that everyone's talking about European OEMs. They are looking at, getting new vendors. Could you give us a
Yes.
sense about, are there such vendors that are in the pipeline where business could flow,
Yes.
say, in the next 15, 18 months or so? Could you tell us that? And from the time of discussion, how long does it take for them to finalize on a new vendor, which Ramkrishna could be in some cases?
See, we are getting a lot of inquiries from the Europe, as what you rightly said, a lot of traction from the Europe for the new vendors. And see, if there is a new vendor, absolutely, the virgin vendor, it takes almost 12 to 18 months. And if there is an existing customer and who wants to increase its product portfolio, it can be done in 3 to 4 months time.
All right. And Europe is about 10% of your revenues, right?
Yeah, and we are quite hopeful to double this revenue in next financial year due to this.
All right. And, as far as the other acquisition that you've made, the one of Tuso, how much are you, expected to invest in all these acquisitions in terms of capex or funding, etc.?
See, Suyo we have to invest over a period of 5 years around 100 crore. So it will be over a 5 year, and that we will acquire 51% in a phased manner. And basically, it's an EV component player or a startup player which have a very good potential to grow. And with the support of RK Forging, we hope it will do wonder in the motor, controller, differential, and EXL space. And they have a good, they have a good capacity, and we will just ramp up and penetrate the market.
So is it basis this acquisition that you are hopeful of EV going from 2% to 5% of your sales, or this is over and above that?
This is over and above that. That 5% of sales is from the RKFL facility alone.
And this is another 500 crores that will come in from there.
Yeah.
All right. Thanks a lot, Mr. Khetan, for joining in and giving us all those details. The street likes what you said, because as we speak, as you were talking, we had seen a bit of a spike up on the stock. Volumes for the next year, you are looking to repay debt as well, and going forward, 20% CAGR is what you've guided for, with higher contribution coming in from higher margin products. Take a short break, come back, we continue our coverage on the markets and individual stocks.